In terms of complete repricing, I think we have to be careful. I think we are seeing a lot of risk-off trading. Now, in terms of what's going to happen in central banks, we had Governor Carney just the other day come out. He watered down expectations of further rate cuts. He even said that there's a limit to what the BOE can actually do. So we will get more cuts from them, or we will get a return to cuts from them, but we've got to be a bit careful on what to expect. I think the global bond market is factoring in just risk-off and weaker global growth.
Okay, if that's the case, I want to know where the trade is here, David. I mean, there must be a trade, surely.
Well, looking at the FX trades, we still like the US dollar in the long term. Now, or even in the medium term, we've got the case that the economy looks like it's a little bit shaky. We're not in the group where we think there's a 60% chance of a US recession. We do expect a decent rebound in non-farm payrolls this week and a chance of a Fed rate hike by year end. We're seeing a more gradual appreciation in the US dollar due to a more gradual Fed. So we still like the US dollar, we still like dollar yen higher, euro dollar lower. Sterling we think is going to continue to struggle.
How? Struggle by how much? I mean, we're 31-year lows already at the moment.
Well, what I mean by struggle is that, well, we forecast it to be around 129 post-Brexit. We've hit those levels. We expect it to gradually climb higher over the coming year. Now, what I mean by struggle is it's going to be tough. It's to get above 130 and stay above there. Now, there are a few reasons for that. The first one is that don't expect a big J curve or rebound in UK exports on the back of a weaker sterling. We have to remember that a lot of the UK's exports are service related, not sensitive so much to price and the exchange rate, and they rely a lot on access to the EU common market. So that's why we think that sterling is going to struggle to move higher over the coming year.
So, David, I got a question for you. It's kind of two-part. One, just how much bigger is this bond? And it is a bubble, right? A global bond bubble going to get, especially when you've got calls from an increasing number of economists that, look, governments, what they should do right now is take advantage of this low, if not record low, if not negative yield situation, and go out there and borrow and try and actually create some demand and stimulate the economy.
Well, you've got to question the wisdom of going out there and borrowing a lot when rating agencies are out there putting people on negative watch and so on. And a lot of governments are still moving towards fiscal consolidation and leaving the slack to be picked up by monetary policy. What we have at the moment is a struggle where monetary policy is pushing on a string. If you push more rates into more negative territory, you're going to hurt your banks. The banks won't be able to lend. So then we go back to, well, the governments have to step up. We do think that under a new US president, well, both candidates at the moment are running more positive fiscal stimulus messages, and you will get a little more fiscal stimulus out of the US, but that will be constrained by the House.